I'm joined by my colleague Karen Manczko, who will provide an update on the Wespath fund performance. Karen, thanks for being here.
Thanks, Joe, and greetings everyone from Glenview, Illinois.
I've mentioned that the markets and economic signals were mixed in the second quarter. Would you agree?
Definitely, Joe. I know that you and Dave explored the headlines in detail, but we saw softer inflation numbers in May, and therefore the Fed took a rate hike pause in June. Still, consumer spending has been resilient, and the economy continues to add jobs. With all of this in the background, the U.S. equity markets were up 8% for the quarter, and international markets were up over 2%.
So given the positive equity markets, how did the Wespath equity funds perform?
You can see that the Wespath equity funds ended the quarter in positive territory, with both our U.S. and international equity funds being up 7.4% and 1.8% net of all fees. And the U.S. equity index fund was up 8.4% net of all fees. The positive absolute performance reflects the strong overall U.S. equity market that I just mentioned. However, on a relative basis, the funds did underperform their respective benchmarks by a little more than 62 basis points and 100 basis points, respectively. I'll review the specific contributors and detractors to the quarterly fund performance here in a moment.
Okay, so positive absolute performance in equities, but it looks like the fixed income assets were down in the quarter, which I assume is where your mixed comments come in.
Exactly. The stock market showed much more optimism than the bond market this quarter. What primarily impacted the bond market is that we saw the yield curve shift higher the last few months. As our viewers are aware, when yields go up, the price of your bonds go down. Therefore, the uptick in the yield curve we saw, the US bond market was down by about 1%. On a positive side, despite the overall bond market being down in the quarter, you can see on the chart that our fixed income fund ended the quarter up 2 basis points. Meanwhile, the inflation protection fund ended the second quarter modestly negative, but did outperform on a relative basis. So all in all, on the fixed income side, both funds outperformed their respective benchmarks by 55 basis points to 125 basis points net of all fees.
Thanks, Karen. So before we talk about specific contributors and detractors, let's get a sense of where we're at compared to others in the industry. Can you tell us how the multiple asset fund compared to other balanced funds?
Sure thing. This chart showcases the multiple asset fund versus a universe of balanced funds. This slide measures how our balanced fund performed relative to other balanced portfolios and funds that are currently on the market. Looking at the chart, you can see that the multiple asset fund has performed in line or above the median across all time periods. For instance, for the 10-year time horizon, the multiple asset fund outperformed 60% of its peers.
Great, thanks, Karen. It's always nice to see how we stack up relative to our peers. So let's go to those contributors and detractors. Can you break down what helped and hurt the funds in the second quarter?
On a gross of fees basis, the multiple asset fund underperformed by 12 basis points in the second quarter. A contributor to the gross of fees relative performance was the outperformance of the fixed income and inflation protection funds. On the other hand, the equity funds detracted from relative performance due to the underperformance I mentioned earlier.
Thanks, Karen. So we had sluggish absolute performance from the fixed income funds, but those outperformed on a relative basis, and the U.S. equity funds were up, but they underperformed their benchmarks. Can you dig into that a little more?
Sounds good, Joe. Starting with the U.S. equity fund. This fund underperformed its benchmark by 89 basis points for the quarter. Starting with a review regarding what contributed to the performance. First, strong stock selection by our active managers in technology, healthcare, and industrials contributed to performance. Our investment managers' investments in companies like Supermicro, which is an IT solutions provider that designs and builds an environmentally friendly and energy-saving portfolio of servers and storage systems, this stock was up 134% in the second quarter. Another example of a company that did well is Intuitive Surgical. This stock returned 34% and is a company that creates robotic-assisted surgical systems. Lastly, excluding tobacco and defense companies was a contributor for the quarter.
In my market update, I discussed the impact of the Super 7, or the large technology companies that accounted for most of the gains in the U.S. equity markets this year. How much is the U.S. equity fund invested in these names, and what impact did it have on fund performance?
Really interesting timing with that question, Joe, as I was just getting ready to review the other side of the slide, which are the detractors. Yes, 7 stocks have accounted for 65% of the total market return. These names are Apple, Microsoft, Alphabet, Amazon, NVIDIA, Tesla, and Meta. Names that we continue to hear over and over. We are invested in these names, but the weighting that our fund has to these stocks is less than the benchmark. This is primarily where the mega cap stock underweight comes into play, and the impact that it had on the performance being underweight from these names was a detractor. Some of these 7 stocks returned 190% and 138%. I know some watching may be asking themselves, why did these names do so well for the quarter? Well, they did well for varying reasons, including customer satisfaction, and the case for Apple and Tesla, or an expansion into AI technology. It is worth noting that the large cap stocks outside of these mega cap names actually underperformed our fund's benchmark, the Russell 3000. So if we take the large cap stocks and remove those mega caps that I just mentioned, the fund's large cap underweight was a contributor to performance.
AI is definitely a prominent economic factor at the moment. Something I mentioned in my market update and we'll be discussing with Dave a little bit later. So it's on a lot of people's minds. Are there any other comments on the U.S. equity fund before we move on?
I do have a few final comments. The fund's modest allocation to private equity and private real estate also detracted due to the strong U.S. public market and these strategies not being able to keep pace due to their lag. Finally, the fund's overweight to small and mid-cap stocks detracted as they underperformed those mega-cap stocks that I highlighted a moment ago.
You also mentioned that the International Equity Fund underperformed its benchmark on the quarter. What were the drivers of the fund's relative performance?
The International Equity Fund underperformed by 44 basis points, and the primary reason for the underperformance was stock selection by our fund's active managers, particularly in consumer discretionary, healthcare, industrials, and materials. An example of this is an online retailer called Zalando, which was down 30%.
Thank you for highlighting that. Now let's talk about bonds and how the 2 fixed income funds performed on the quarter.
The fixed income fund outperformed by 70 basis points for the second quarter. This was a risk-on quarter, meaning that investors were more interested in the riskier corners of the market. Therefore, the fund's allocation to emerging market debt and manager issue selection in that style contributed positively. Along with the fund's overweight allocation to high-yield bonds, coupled with manager issue selection, also contributed. Finally, the fund's issue selection in investment-grade credit was a contributor.
And are there any detractors to fund performance to comment on?
What detracted from the fund's performance was the global bond manager's issue selection. The manager was overweight the short end of the yield curve, and we saw rates rise, which impacted these bonds negatively. Also, the fund's allocation to government credit bonds detracted.
And what about our final fund, the Inflation Protection Fund?
The Inflation Protection Fund outperformed by 137 basis points for the quarter. The fund's overweight allocation to global and emerging market inflation-linked bonds contributed, along with the fund's allocation to floating rate senior loans, as we saw rates rise during the quarter.
Thanks for the performance update today, Karen. We appreciate your time.
Thanks, Joe.